All right. Well, so for some of you, this is just another Tuesday in paradise, market-wise, and because it's 4 o'clock on Tuesdays Eastern Time, this is when we get together. If you're a member of the Substack Premium Service, it's Seeking Alpha Investing Group. And if you're not a regular, then allow me to introduce myself. I'm a man of wealth and taste. Now, that's Mick Jagger's line, I think. I'm Rob Isbitz, and this this is really something. I'm still amazed we can get people together like this in so quickly. And honestly, I've never been what 130,000 hours I've spent in the investment business. Started in 1986 in the World Trade Center in New York. Dad taught me to chart stocks when I was 16, graph paper and pencil, and he was a do-it-yourself investor, just like the folks that we tend to attract. But I took about a 30-year break from working with do-it-yourselfers, namely my dad, who didn't do it professionally, to until I was able to return to helping people to try to help themselves in what are now these crazy and wildly misunderstood markets. I took about a 30-year break because I was a fiduciary investment advisor, a strategist. I had three kind of main tours of duty. One was a firm that I started when I left an old brokerage firm by the name of DLJ, Donaldson, Lufkin, and Jenrette in 1998. That was after we moved from New Jersey, where I grew up, to South Florida, where we have stayed. And that, by the way, if you're ever wondering why Sun Garden Investment Publishing has that name, it's because we moved in 1997, my wife and I, and then later three kids. Uh, we moved to the Sunshine State, Florida, from the Garden State, Sun Garden. I never wanted it to really be about myself or family name or anything like that. Although if you go and Google, Rob Isbit's investing or anything like that, or especially if you use AI, honestly, it's like my beloved late mother, won't stop talking about me. So um, there's a lot there, and I say that uh, primarily because AI is a big part of what we do as investors now. I mean, a lot of the hedge funds and such are using it. I'm a hedge fund manager at heart, even though I didn't run a hedge fund. I had one RIA firm that we built when I came out of DLJ, and then I got recruited by a guy in the Midwest who ran about a $3 billion investment firm, and I was his chief investment officer. So, I had my year in the big time for running about 3 billion and teaching the advisors and all that stuff, and working with some very high end institutional investors, things like that. And after 1 year of that, decided that we wanted to start our own boutique firm, which was the original Sun Garden Investment Management. And we sold that in 2020 to try to expand the audience. We had only worked with 30 families, about 80 million under management when we sold it. And we like that boutique feel. And honestly, that hasn't really gone away. I'm not a fiduciary anymore. I don't give direct advice to people. Will there be a comeback in that business? Honestly, if enough people came to me and said, "Wow, I'd love to have like a fiduciary relationship, with you and yours." Yeah, we have always been. When I was a fiduciary for 27 years in those three different stints, and now post fiduciary, where I talk about what I'm doing and what I know from 30 something years, 130,000 hours of this, uh, being really the only industry I've been in. Uh, you know, we're just trying to figure out at this sort of semi-retired phase of our careers, Dana and I, wife and business partner, uh, we're trying to figure out, who can we map that experience, that uh, I think premier ability to stay out of trouble on the way to just trying to grow what you have. We don't tend to appeal quite as much to the, hey, I'm just starting out, how can I make 30% a year crowd? They tend to come and go. uh, and so again, what we've always wanted to do in the, I guess, 6 years since I retired from managing other people's money directly, um, is frankly, we've just tried to do two things: be useful, given what I know, and after a couple thousand articles and all this time in the business and interacting with so many people at different levels, I feel like there's a lot to offer. That's why we still do this. You have a lot of things to do with your time. We have a lot of things to do with our time, and this is what I love doing. Um, we like to be useful, and we like to get paid fairly for it, and that's it. I mean, those are really the only two things. So, just as in any earlier iteration of what is now ETF yourself, primarily on Substack, uh, you know, it's always been kind of the same thread. Um, I can teach, I can coach, I can mentor, I can deconstruct, and I can simplify virtually any investment topic that has to deal with the public markets. However, that's a lot. So, what we have tended to do over time is to distill that into what do people want from us. And so the more feedback we get, the better off um, I think everybody is. So, with that introduction, what you're looking at here, and I'll give you a quick little tour here, and I will go back to the the agenda we sent out. Um, so, matter of fact, here let's do this, because a lot of the stuff I've written recently and all was kind of with speaking to this group in mind. Uh, you know, if I always ask myself, why do people show up? Why do people ask questions? Why do they want to learn from me? Again, if you ask AI or you Google me, you'll see, I guess, a lot of reasons, but um, I tend to focus much more on how I can translate things. Um, and this really is what a lot of it comes down to. Okay, two types of investors. There are people who proactively manage risk because they've learned from experience that's the key to long-term success. And those who haven't learned it, and you know, because they probably haven't experienced it. Somebody told me a long time ago, they said, Rob, there's two there's people who have been through bear markets, and when they have, it changes the way they invest for the rest of their lives. It doesn't mean they cower in the corner. It doesn't mean they buy T-bills and chill for the next 20 years. But this is where things like, if you've read about the work I do with bond ladders, which despite all the ETF and stock talk, my bond ladder is the biggest part of my portfolio. And I'm happy to share, up to a certain point in detail, what I do with my own money, because that is the business that I'm in now. But I also don't assume that what I do and what's good for me is best for anybody else. That is their decision. And I think to kind of warm you up for what we'll talk about for probably about the next 40 minutes or so is I think there's a major communication gap that goes on between people that are trying to be their own investor and people that allegedly are trying to help them to be their own investor. And here's what I mean. Somebody told me a long time ago, message delivered is not necessarily a message received. I think the people on the receiving end really want to learn. The people on the delivering end, frankly, there's a lot of really good ones. There's a lot of really honest ones. There's a lot that, like us, even though we're not technically fiduciaries, we try to think like fiduciaries. You can't take that mindset away, even if we are not, officially that. Um, but there's so much salesmanship that goes on. It's not just selling for revenue, it's selling of product. And yes, we wrap our services around things. Here's a $150 level, is a $600 level. And as I'll mention very briefly at the end, we're looking at tacking on something that is a little bit more, let's call it intimate coaching, direct without being fiduciary. The sky's the limit as far as we're concerned. Like I said, we just want to be useful and get paid fairly. Those are the only two things. So, and look, I spent all this time up front before we talk, numbers and charts and philosophy and things like that in current markets, because really we are at a time in, I think, the history of markets and the history of the do-it-yourself investor, which has come a long, long way since I started in 1986 in the World Trade Center in New York City. It's come a long way, but at the same time, it's kind of like when the money's there and there's all these people learning how to invest on their own, okay? It it brings out, you know, all of the vermin, shall I say. Um, and as a career, technically now former fiduciary, that pains me. It pains me as somebody who has spent his whole career, starting with a dad that grew up in the Depression in New York City and taught me to chart, and today I carry that on for my late father, and anybody else who thought like him. First, if you've made some, you better protect it. And after you know that you've done everything realistically possible to make sure that if you lose money, it's not catastrophic. Small losses are fine. It's part of the process. Okay, anybody who tells you otherwise is full of it. But big loss, big loss is the one thing that, at least in my book, you cannot have unless your dollars are so small that a big percentage loss doesn't matter. And I mean, I'll put numbers to it, okay? If somebody's portfolio is $10,000, $20,000, maybe even $50,000, uh, yeah, and you knock 30, 40% off of that, it might sting. You might not admit it, when you go out for dinner with your friends on Saturday night, because people tend to talk about their winners and nothing else. But once you start getting into that six figure, mid six figure, upper six figure, a lot of the clients, really most of the clients we dealt with back then, and again, 30 families, 80 million, so you can do the math. I mean, they're all kind of 1 to 5 million types, some little bit bigger, a couple much bigger, and then several kind of in that next gen or friends of, et cetera. The kind of a couple 100,000 and up. So we've worked with the entire spectrum, but this is different because you're the decision maker. And so again, I go back to, there's so much information coming at us every day, and I don't know. To me, even as somebody who's absorbed as much as anybody you will meet over the years and seeing the whole evolution from when nobody knew what an ETF was because there were no ETFs. There were mutual funds. And I was a manager of three different mutual funds. They all were hedged in nature. So I've been doing this a long time. Um, the first one was opened in 2008, August 14th. The market fell 55% in 7 months. That's the S&P. NASDAQ was worse. 55%, double nickels in 7 months. What do you do as a fund manager? Well, first, if you know that markets are cyclical and going into 2007 when we formed the fund, 2008, there was not that much reason to believe that the good times wouldn't just last forever, kind of like in late 99, early 2000. And I don't know when markets shift violently. All I know is I'm not going to be the last one to figure it out. And I'm always, as a normal course of business, always think defense first. Because as I say all the time, and sorry, probably repetitive for those of you who are here regularly with us, any security can go up in value at any time for any reason. Let me think of one recently. Oh, Oracle. Okay. I don't know if anybody tracks Oracle, but I'll use that as the example. Oracle went up 35% in a day. Unbelievable for a company that had reached the size it has. And this happens, I mean, maybe not 35%, but you get 5, 10, 15% on earnings all the time. And there's probably no chart system or anything else that could predict that this could go up 35%. But it just goes to show in the same way that we've also seen the opposite in the individual stock world. And look, my rookie year in the business was 1987, October 19th. The Dow dropped 500 points. That was the good news. It was only 500 points. The bad news is that was 22% of the entire market back then. So, put it in perspective, right? Dow was only around 2000. So, this is all a discussion of why I think that risk management matters, being proactive about risk management matters. But it's one thing to have that philosophy. But for a lot of people, they haven't had to learn it. 2009, I mean, really not, or early 2009. The last time is right when I started managing that first fund. August of '08 to March of '09, 7 months, 55% down. And that's if you held the index. But what has changed since that time is in some ways more dangerous and in other ways more opportunistic. What has changed since that time? Everything has become instant information, but the players have changed. Talk about this all the time. The players have changed. What do I mean? Indexing used to be big. John Bogle at Vanguard, brilliant, brilliant investor and leader. Um, Vanguard led that indexation movement to the point where everybody drops money into 401k plans, put their money in the S&P 500. And it's created an air of invincibility when in fact, all it would really take to knock this market out is for maybe another 1%, 1.5% of the population to lose their jobs, which supposedly is one of the things that people are most worried about with the AI boom. Why do I say that? Because there is something called the passive bid. I didn't invent the term. A guy named Mike Green did. You could look that up. Bill Fleckenstein who is a money manager, I think also like me, kind of semi-retired out west, has talked about this a lot, podcasts, things like that. Uh, the whole of the passive bid is every day there's people pouring money into 401ks on automatic investing plans. And that's not the only source, but it is one that didn't exist the way it does now. Okay, there's a lot of institutional money that's just indexed. And that's great for a while because it's all this money chasing, okay? Inflation be a very hot topic right now, right? What's the definition of inflation? We learned this first day of business school a long time ago. It's too much money chasing too few goods. That's inflation. In other words, in this case, there's only a limited amount of stocks and market capitalization in the SP 500. If more and more money keeps going into it, well, what does an index fund manager do? I'm teaching you the mechanics of what will ultimately be the market's downfall. I just don't know when. Don't know what week, month, or year. But I know that it is probably the number one thing that every investor should be aware of so they can decide to what extent they want to prepare for it. Again, I'm talking about this. The the last time true risk management mattered. It's reached the point now where all this automatic money going in, index fund manager looks at it and says, hmm, I don't know. Nvidia is kind of flat for a while. I think maybe the momentum's gone. Maybe I won't invest. No, it's an index fund. Okay, if Nvidia is 8% of the index, 8% of the dollars, it's all automated. It goes in. This has had such wide ranging impact on how the markets function. Passive flows into these passive indexes, in particular the SP 500. Why do small caps stink now and have underperformed for a long time, probably will for a while? There's not enough index money going to it. Well, what about the Dow? Well, the Dow is a quirky index, not a lot going into there too. Well, what about the NASDAQ 100? Okay, all the Mag 7 companies and all. Well, guess what? The Qs and the SPY, they move together now, much more than they ever did before, and much more than the SP does with his average stock. RSP is the ticker symbol in the ETF. And that's the problem. It's all one big trade. Okay. Now, that doesn't mean that there isn't room for adding value, alpha, as they say, and we're not all wedded to the S&P. We have to work around it. But working around it is a big part of risk management and understanding how the markets are structured with, as I've written many times, 25 stocks of the 500 in the S&P make up nearly half the index. I think it might be right at 50% now. It's 47, 48% earlier this year. 50% in 25 stocks. 475 stocks, 50%. So if you had a huge rally in materials companies and utilities and REITs, some of the other small sectors, is that going to move the market? The market which so many fund managers are trying to closet index, as they say. Oh, I'm a growth manager. Well, what do I really do? I look at the top holdings, I cut out a few, I add a few, I put a big fee on it. I'm an active growth manager. The ETF era has drowned out some of that, but it's still there. It's still there. That was the environment in which I managed money, myself for a long time years ago. So look, the passive flow or the passive bid has been great to generate wealth, but don't think for a minute that it can't take it away just as quickly. And I don't know when, I don't know how, I don't even know if. But that's not our concern, right? Ours, I think, is an old expression. Ours is not to wonder why. Okay, we just have to be prepared. So, how do you get prepared? Well, that is what the entire site. etfyourself.com is really related to. Um, my guess is and are familiar with some of this because you're already a subscriber at some level. Thank you. Um, I'm going to break it down a few ways, and I'm going to go into some current market stuff. So, uh, you know, every time I write about two topics in particular, uh, the readership numbers are off the charts. I hear it from my bar chart people. I hear it from the Seeking Alpha people. I see it in my own work. Um, there's the closest thing Rob Isbitz gets to going viral is when he writes about either the simplification of investing through two ETF portfolios. Okay. I call it the two ETF portfolio. And the basic case of it, and you may have seen the numbers, pretty good, pretty simple. Uh, but it's just investing in a nutshell. Find a way to play offense. It can be the S&P 500. It can be anything. And that's what we teach. An offense weapon and a defense weapon. What is the defense? Well, it could be cash or it could be anything else. It could be relative. In fact, one of the portfolios I designed with our friends at PieTrade in the roar.pietrade.com site that I'll work from here in a minute is a portfolio that says the offense is QQQ and the defense is the Dow, DIA ETF. Why? Because they are different enough that there is some, I wouldn't call it arbitrage, but there is some benefit to allocating among them. I did not say choosing between them because a lot of people hear two ETF and they say, okay, which one are you in now? It's timing strategy, right? Very exciting. Wow, I'm going to beat the market. No, the way you beat the market is by not losing big in down markets. That's how you beat the market. Okay. If you try to compete with it on the upside, forget it. You can do it for a while, but you better have guts of a burglar, as they used to say. I'm sure some people can do it. You can also use a lot of leverage. Okay. And look, I mean, we don't get into it a whole lot in here, but I'm always open to talking about it. Things like bond ladders, which is a real anchor in my own portfolio, using things like option collars around positions. I mean, that's the more complex stuff. I'm focusing today mainly on the idea that it can be really simple. And it may start with SPY Bill as one two ETF portfolio, but it's the concept. People always want to know, well, what do you like here? I mean, I'm one investor. And I mean, there was a time I managed funds and private accounts where the whole idea was people would hand their money off to me and my team, and we would make all the decisions. Um, the the pietrade.com app is about the closest thing in the last 6 years that we've had to that, uh, where I deliver the research, I've delivered the model intelligence, and they have turned it into, I think, is actually a brilliant and very flexible toolkit that people can use themselves to build portfolios, to ETFs, to stocks, whatever. Um, and or they can just say, you know what, for some of my money, a lot of my money, everyone makes their own choices. Um, let me push a button and it'll be run the way Rob's portfolio is run for that strategy. So the idea is, we created a few of these, we'll create some more. And then, there's the what I wrote about just yesterday and finally put out a full paper on this. Okay. Designed to be a little bit on the academic side. Um, And this is an expansion of what I was talking about. So let's quick review here. All right. You know a little more about who I am. Risk management is important. You can do it with as little as two ETFs. In fact, before I get to the 10, let's go back to this here. Okay. If you're not familiar with roar.pietrade.com, why not? It's free. It's going to be free for a while. At some point, we'll charge for it. But at this point, people can do a lot. So let's look at this as an example because I just wrote about this in Bar Chart. If you haven't seen my barchart.com column, I write about 10 times a week there. I write fast and yeah, and I've learned a lot. So easier for me maybe than for most people. So let's take this, okay? I'll just put $100 in here, okay? Um, yeah, you can build any one of these that you like, but here's what I did. I want to show you risk management in action. Let's see here, 5 years, I think was the period. There we go. Okay, wow, spot on. Okay, so what am I looking at here? For those of you who've been with us for a while, you remember Spy Bill because when we first started on Substack, in the first week of 2022, just as rates were starting to perk up. By the way, biggest difference other than indexing uh, for why markets are different now, because we actually have interest rates that show up on the chart. For a while it was the interest rate was, you couldn't see it. Okay, it was point zero something going out almost 10 years. Not anymore. Do you know what an advantage that is? Yes, I know inflation's up too, but it gives you some wiggle room. There's things you can do with bonds and with interest rates, ETFs related to bonds that relatively few people in my position, strategists, researchers, writers, have picked up on. So part of what I'm trying to do here is I'm trying to teach people not what a bond is, okay, or what a bond ETF is, but why understanding a little more about how you can use them, right? I mean, we're not just spewing facts and figures here. It's all about application, okay? Because as I like to say all the time, yeah, we're trying to teach people to be the why. I don't mean like what's your why, okay, as the expression goes, but you're a do-yourself investor, you're a DIY. What I see, and frankly, the people that tend not to fit our program and our services are the people that say, well, wait a minute, I thought you were just gonna like give me all the moves that you do and I'll just copy them in my own portfolio. Well, that's arguably lazy, but more importantly, you're not the why. You're not the letter Y, the yourself in do it yourself. And people have to decide. When people said, "Here, you do it," back when I was an advisor, we would get to know them really, really well to the point where they could make the handoff and say, "Here's the money, goes in accounts, million here, half a million there, whatever." Okay, and we charge 1% on the assets, so people were paying us two to 20,000 to 50,000 a year. And it was more than money management, but I wasn't a financial planner. So it was based primarily on the portfolio and the strategies I built. The 10 ETF portfolio, which I'll get to in a few minutes, is a really the modern version of the way I approached investing back then when I was an advisor and even the funds I ran. The only difference is I've modernized it for today's markets. And I'll make sure I finish with that because it kind of builds on this other stuff. But honestly, I mean, it doesn't have to be complex, but it also can't be so simple as leave it in the SP 500 and over time it'll be fine. I mean, I heard some people tell me that recently. And I said, okay, fine. I mean, you got to go back and look at the history, ancient history, like earlier this century. Um, Surprise, from the end of 1999 until the end of 2012, I believe, 11 or 12, 12, 13 years, okay? About half this century. You know what the return of the S&P 500 was? Zero, goose egg, nada, nothing, zilch, okay? Uh, 12 years, zero return because you had dot-com bubble. That was 3 years in which the market kept falling 50% or so at the low, and then you had all that time to try to make it up. And just as you were starting to make it up, uh-oh, global financial crisis, 07, 08, Bear Stearns, Lehman. Okay. Uh, so that's how you get from the end of 99, when things are about as ebullient as they are today. Different, but definitely rhymes. I was there. Late 99, late 2011, I believe it was 12 years. You had to go through two of those. But remember, most people have not been through that because even if you remember the global financial crisis, were you the investor then that you are now? I mean, I guess if you're, maybe one of the older boomers, late 70s, 80s, maybe that's the case. But I mean, I'll be 62 later this year, and I mean, of course, I was doing it professionally, but I can tell you, if I was working as hard as I was in some other profession back then, 2008, uh, 18 years ago in my 40s, no, I was not thinking about my own portfolio. I was thinking about everybody else's portfolio, but my own portfolio was building. And I think for a lot of people, like, unless you have been that focused on what your own money was doing on a frequent basis 15, 20 years ago, as you are today, then you really haven't experienced anything but relative bliss. Central banks suppressing interest rates to get through one crisis after another, kicking the can down the road, as they say, to try to make it so that we could keep inflation at bay and we could keep growing. And that worked out brilliantly. Maybe not for the average stock, as you'll see in a second, but at the high end, where all the money was going into the S&P 500. I'm giving you kind of a quick tour of the last 20 years interspersed here, um, to help understand. Pardon me if I'm being a little history professorish today, but kind of my nature. So, because look, we learn so much from the past. We don't learn about how to do it exactly. We learn about what I call the ROPO, the range of possible outcomes. And most investors today, they look at it as, well, what are the chances? Okay, the market can go up and go down, but eventually it's going to go up. Okay, that may be true if you have a few decades. Okay, the problem is when people say, well, why should I just invest in the SP 500? I don't tell people what to do anymore, and I don't do it directly for them. I do it indirectly through stuff like you're seeing here, the copy trading and models and things like that. Um, but I will say this: if you invest in the S&P 500 and that's your kind of main risk level, uh, and you think that there is some level of safety there because everybody's doing it, um, then you would be ignorant to history. History as recently as the first half of this century so far, as I mentioned before. And really, when you think about it, when people say, okay, so what do you think of the SP 500? I say, you know what? If you're good with the idea that in a given 12-month period, or let's say a given calendar year even, uh, you might make 40%, you might lose 40%. That's kind of your range. Like, no, that doesn't happen. 2008, look it up. The S&P 500, 37%. Um, yeah, those are the markets where I shine. In fact, I don't know if I can find it, but it was institutional investor back at the time. The fund I was running, and we started in '08. I told you 55% down. Quickly, we were down, I think 16. I swore it would never happen again, and it never did. That I'd lose 16% from peak to trough, even if the market was down 55. But when you took '08, '09, and 10 together in our category, we were number one in the category. Why? Not because I had a zooming 2009 and 10, because when the recovery started, everybody else was way down here, and I was still close to where we started. That is the value of anything that you pay to work with us. In the opinion of the founder, there's never a guarantee, but boy, if you have all the tools, if you're throwing everything you have at it, okay, and you understand what is useful in investing today, a lot less than used to be. Not many stocks. What I tell you about the stocks, right? 25 stocks basically run the market. Okay, you're going to own the others. It's here and there. Okay, the most ETFs don't matter. There's 4,000 or so in the US. I'm going to say 2% of them probably matter. In fact, there's a list on here. If you go to the watch lists, and you'll see 75 ETFs, that's my chosen watch list. Doesn't mean I would own all of them, but I use it to kind of scour the markets on a daily basis. And going forward in these Tuesday sessions, I'm going to really, really drill down on that, because it's getting really important now that the markets are doing what they're doing. Okay, so let's try to wrap a few things together here and then take any questions you have. I think I've covered the philosophical and the history and kind of bringing together the last 20 years in about 45 minutes. So what are we looking at here? We've been staring at it for a while, right? Because I put it up there and I didn't do anything with it. But okay, we're going back 5 years. This is very simply, okay, and they all work this way. Okay, anytime you look at something on Roar.PieTrade, here's how it works. Very simply, there's two ETFs. One is SPY and one is Bill. SP 500, 1 to 3 month T-bill. At any point in the last 5 years, $100 was going to be divided between these two. There is no third option. Okay. Well, what if I don't want chocolate or vanilla? I want strawberry. I want Rocky Road. Sorry, we only have vanilla and chocolate. Okay. You decide which one's vanilla, which one's chocolate. Again, it's your preference. See, you're the Y and DIY. So, how is this determined? Is it all in, all out? Obviously not. The current reading is 20 and 80. It's the Roar score. And look, I haven't gone into a whole lot about the Roar score because the website's filled with it. And I'm not here to sell the Roar score method because portfolio management, sure. This is all about the Roar score. If you make it this far, and you can learn all about it here on this site, that's why we built it. This is my research portal. We're just making it available in large part to everybody, and then we'll figure out which parts we continue to to make available. And I'm using it as a teaching tool specifically for this live group. And our $600 a month, $600 a year service on Substack. So it takes the ROAR score, okay? Reward, opportunity, and risk, or return, opportunity, and risk. All it's really saying is there a chance of a big decline? If so, you're going to see it in a ROAR score that is going to be in the red zone. All right. I'll show an example of that momentarily. The colors and the numbers, probably do separate session on that. But again, we have so much information. And again, this is not a, sell the ROAR score methodology session. It's quarterly and designed to be more broad. So all we did was we took SPY and Bill, offense and defense. You could have put any other offense, any other defense in here to your preference, and you can, and in seconds, it will run something just like this and give you the analytics. But this is the simplest one. And dare I say, it's threatening to make me believe that not 80% of investors probably just need something like this. It might be closer to 90, maybe even 95. Why do I say that? Well, the last 5 years, we've had a little bit of everything, right? We had the 2022 stocks and bonds go down at the same time, the way they haven't since the 1970s. And then we had this vicious dip in here, Liberation Day, and the whole thing. I mean, we had a few other scares along the way. We also had some real rips, as you can see. Okay, and we've had a few flat periods, especially the recent one. So you've had a little bit of everything. And what happened over those 5 years? Well, all we did here was said, okay, SPY, Bill, those are the only two choices. Whatever the ROAR score of SPY is every week, that's the SPY allocation. The rest goes to Bill. Simple. You plug anything else in here, it's going to do the same thing. So if you want to test a stock, okay, I want to put in IBM or Cisco or the other Cisco or NVIDIA, okay, or Tesla. You put it in, you run it with Bill, and it basically says whatever the ROAR score of that was at the time, that's the allocation. The rest goes to Bill. And it helps you figure out, as I will be doing a lot of this and putting it out as research, it shows how it's less about what you own and is about how much of it you own at different times. It's allocating within each security. Pick the securities you like, hold them for a while, and and then let the allocation decisions guide you. Okay, thank you for the heart. So here's the punchline. 5 years of doing that. Well, you would think, I mean, there's no way it's going to compete with the average S&P stock, the mighty S&P 500. But when you take away the weighting and you put them all equal, that's what RSP does. All 500 stocks are equally weighted. It's not 25 stocks equals half the index. When you do that, it's a very fair fight, is it not? Except for a couple of things, and you have to look closely to see this. Okay, when the market falls hard, SPY Bill, it's going to take a little because it has the only hedge is Bill. Okay, it doesn't have an inverse hedge. It doesn't have something that can make money in a down market. That's the next level. I'm trying to keep it basic here. 2 ETFs, offense, defense. Okay, defense is cash. Then what we teach here is, okay, how do you add on to that? You got SPY and Bill. All right, you want to add more offense, you want to add more defense. I mean, in terms of the names you use. And then you let the ROAR score or some modified version of it or whatever you want to do. Remember, it's 3 things: offense, defense, and some allocation rotation process. That's investing, market down, at least according to Rob Isbitz. That's investing today because the markets are too mechanical and two, influenced by passive bid, algorithmic trading, emotions, 24/7 news cycle, all that. Okay. These are all reasons why investing just is not the same as it used to. And that's why I'm still working, because I think it's an important message to leave, while I still can, and to try to coach others. So anyway, you escaped a bit of a dip here with a nice flat period. Oh, look, it did it again here. Okay. You would much rather not be the inverted triangle there, if you see what I mean, down here, right? Up here. Okay. Flat. It didn't slam on the brakes, most likely, and the Roar score didn't, go to zero on SPY, but it was low to begin with. It anticipates, because it's all based on my technical analysis from age 16 till a few months ago, and then translating it through a brilliant programming team at PyTrade to create roar.pytrade.com. And now being able to apply that in seconds. It's reading the chart the way I have told it to read it, but I don't have to do it myself. I can do it here. And then I can step back, and with you folks each week, I can help you make sense of it. Here's the third little dip. There's Liberation Day. Okay. Now, look, it doesn't always recover as quickly, but one time, it only takes one, you're going to get that scenario where it's going to cost you years and cause you to make some changes. Okay. So what happened here? Let's summarize. This is 5 years. First of all, how many people are surprised that the 5-year return of the average stock in the S&P is only 6.6%? I've been writing about this for a while now, but so you actually equaled the return. And again, the max drawdown, 13. I mean, it's more than I would personally accept. I'm more like 5, 10 if I completely misjudge something. Okay. But again, this is only using cash, so it can only take so much. But, it did avoid the worst of it. Okay. And I won't cover Sharpe and Sortino other than to say those are pretty good numbers. So that's that. You can do that for just about anything. Now, let's go to the 10 model. I wrote about it here. Okay. Answer any questions. This is the setup that people are used to. I have no problem telling people what's in here. Okay. These 10 are here, and they're always here. Always forever? No. You've made a couple of changes in the last few months, but the idea is that until there's a reason to move something else in, I'm going to have 2 ETFs that are my primary equity vehicle, Qs and DIA. Why? Because they do move differently enough. So I'd rather have Qs and DIA altering with each other as opposed to SPY. SPY has become a blend of these two. It really has. Happy to write or speak about that separately another time. I think you need to have commodities in there. I don't love commodities, but this is one of my favorites. It doesn't have a K1 for taxes to the extent that matters. Again, we don't give tax advice here, but it's about 50% energy, so it's been working pretty well recently. Gold was a house of fire. Okay. I don't know what it's going to become a house of next, but there are times where I like to have at least some of it. Microcap stocks is what I added in most recently, and the reason is, I don't like small caps. These are the smallest of the small caps, and the way I figure it's going to be a very small position, and these two are really going to drive most of the equity exposure. But honestly, so much equity exposure, it just moves up and down together, guys. Okay? It's hard to find alpha, if you will, beyond a brief period of time. Much easier to trade stocks or sectors or industry ETFs and make money, I don't know, 10, 15% over a month or two, actually easier than making, let's say, 40% over 3 years for a kind of long-term average return in the low double digits. Really, really tough. This is what a lot of my research has been focused on. And that's why when you look back 5 years, you say, well, how'd the average stock do? Average stock, all you needed was a defensive minded tilt toward cash uh, and the SP 500, and you would have beaten the average stock. That that's speaking as much to how sustainably weak the equity market has been, except for the ones at the top. That is a problem that doesn't go away until it busts the market. And since it's eventually likely to bust the market, and we also have fluctuating interest rates and a lot of political stuff, not just the recent, but just constantly, okay? So much noise. Remember what I said about an hour ago? So much noise, so many things we have to process. It's okay to keep it simple, but keeping it simple doesn't mean oversimplifying the process. And that's why having created Roar, which again, I'm not talking about a whole lot here today, but it is the backbone. It drives everything else. Why? Because it's designed to try to ABL, avoid big loss. And if you do that first, then everything else gets that much easier. You are in the catbird seat, especially times like now. So to finish here, okay, that's the offensive team. The defensive team, Govey is basically treasuries 0 to 30 years, equal weights across. So kind of like a ladder, but different from the bond ladder I run for myself. Again, can always talk about that. And then I pair it up effectively with this. Most people don't even know that when rates go up, it's like, oh, your bonds are gonna get crushed. You buy TLT, the very popular bond ETF, invest in 20 to 30 year treasuries, and what happens when rates go up? It gets just absolutely hammered, like 40% over 2 years or something earlier this decade. Well, if you even have the forethought to say, maybe I'll include TBF in that long term mix where I always own at least a little bit of it, that's how this works. Okay, these were all selected very specifically. I've been at ETF research since 1993. Why? Because that's when the first ETF came out. And before that, I was a mutual fund analyst, alongside being a chief investment officer and fund manager. I'm an analyst at heart. So these two pair off nicely together so that if rates are going up, down, or sideways, some combination of these is probably going to help. And again, it's not about any individual line here. This is like a team of 10, call it baseball plus one, maybe the manager. Okay. You don't win a baseball game because one guy did all the work. You can't have one guy playing all nine positions. Okay. I'm a baseball historian, so I can't help but mention there are two players in history that I know of that have actually played all nine positions in the game. Anybody wants to email me on that? Nice poll question. All nine positions in the same game. There's two players for sure. There might have been a third. Anyway, but I digress. So you don't want that situation here, even for a game. You want them all to play their roles, their spots on the field, and to work with each other. Because the only way you get in the win column is if the team does it. And a portfolio is a team, just like a baseball team or a team in any other sport. The last three here, BTAL is kind of a quirky, smallish ETF, smalls like 250 million in assets or something like that. Okay, but that's small in today's fund world. So BTAL, it buys is long, okay, is long um, low volatility stocks and is short high volatility stocks, and that's how it does it. Uh, so basically, when the Nasdaq is falling and the Dow, or let's say the defensive sectors are rising, this does pretty well. So I like it along with VIXI, which is like straight VIX volatility. Volatility spikes as it occasionally will do dramatically. This thing could double in a matter of weeks. I have seen it gone up by 5x. If you even had a 1% position in VIXI and it went up 5x all of a sudden, you've just added 5% to your return. That will make up for a lot of losing over here. And that's the whole idea. They all work together as a team. And then lastly, there's Bill, and this is the residual. In fact, as I wrote in the premium weekly letter today, we have a rare occasion here in which the vast majority of these are at their minimum weightings. Well, what happens when you have a lot at the minimum weighting? Well, there's nowhere else to go. I mean, you can't, minimum is the minimum. If they're forced down, every one of these has one. Okay, they're bigger ranges up here, smaller ranges for these kind of wild card positions like this. Cash is the residual. So if it's low end, low end, low end, low end, low end for most of these, you got a lot of unaccounted for assets to place. That goes in here. I believe that Bill can go up to 55% if all the others were at their minimum. And as you'll see, it's not at 55, but it's a lot higher than it has been. That right there is a signal. It's either a signal that bad things are going to happen or that nothing is happening right now. And that's what I include in here, some history. Just again, read this. It's out. We put it out for everybody, so you should be able to get it. We have a whole back test here. Um, again, I'm not the guy who sits here and brags all day about my performance numbers. I try to let the numbers speak for themselves. Plus, this is a back test. It's a back test based on exactly what you see here because this is how we got the numbers. Okay. Now, only I can see this part. Okay. But just so you know, I'll be using this a lot. Okay. That portfolio I can see because it is part of the premium line there. But there's a lot of others that you can put to work or to kind of finish up on this. Okay, you can put in just about anything you want here. Here, NVIDIA was in the news today, right? They always are. Okay. Pretty good example, actually. All right. Because again, there's different levels here. Okay. If you want to simply get a quick glimpse, a few minutes a week of what I'm thinking, and now with this built, really built out and building on it every day, this thing's becoming a whole sort of do-it-yourself research platform. Okay. But unlike any other do-it-yourself research platform, it has something they don't. The Roar score built into every security every day. So I can look at it and I can guide our subscribers on what I see using this, but at the same time, I don't have to be a slave to it. And I'm sure there will be times where I'm like, I'm not sure that that signal is as kosher as, the usual signals. But if you look at NVIDIA, it's a pretty good example. Okay. I'll use this one because it's so popular. Maybe I'll get a social hits or something. I don't know. So NVIDIA, was coming off of this, and all of a sudden, yeah, you know what? It's gone from red territory, and you can read all about this here. Gone from red territory to, all right, maybe it's the risk is a little more balanced. It's a little more average. Okay. And that was worth a run up. This is not a buy, sell, hold system. Okay. It can be used that way. I'm working on trying to figure out a way that is reliable, buy at this level, sell at this level. It may not be as clean, but I'm figuring it out. But again, that's, as we like to say around here, we can feed you a fish today, right? The old expression, we can feed you a fish and you'll eat today. Manja. Okay. But if we teach you to fish, you can fish for the rest of your life. And that's what this is all about. And letting every subscriber decide. You want the shortcut from Rob every week, highlights, etc. And now those little daily posts we're putting in, the almost daily roar, where I'm using this. And, oh, that's interesting. Let me pop that out there. Okay. That's $150 a year or 15 a month. Um, Full disclosure, my guess is that price is going to go up pretty soon, but nothing official yet. Next level up is $600 a year, founders level, and that gets you everything for the 150, except it also gets you, this discussion, but obviously a little more pointed each week because I'm not giving a quarterly sort of overview and bring in 20 years of history. But in fact, we may even start to do almost like topical every week. Nice thing is you also get the video. So, I mean, it probably adds up to 50 hours a year of my time for another $450 a year. We're looking at that price too. But again, nothing's really been decided. And For those of you that we have gotten to know pretty well, and you've gotten to know us pretty well, I alluded to this. I kind of teased it in the little announcement here, so I'll just mention it. Probably cover it next week. But if you're interested in this, just email us info@sungardeninvestment.com. Um, I have to figure out what is the um, simplest way to do this, but I am trying to figure out how we can have an additional level of this service where beyond the 150 a year and the 600 a year levels, that I can make myself available for what I would assume would be one-on-one consultation, not personal advice, not unless I go back and get licensed again. Never say never, but uh, primarily one-on-one coaching, helping people use all these things, going a step beyond. And it would probably be an annual fee. I mean, look, there's there's a bunch of you that were with us on Substack originally. We were charging $300 a month. And one reason we know that people were enjoying it is because even though they could get it for 3,000 a year and save $600, not a single person took us up on it. Maybe they forgot about it or something, but we went on with that for a while. And, we got to the point where we're kind of like mentioning it to them, like, hey, as a reminder, you can save money. Okay. Then we went to Seeking Alpha, and our focus these days squarely is on Substack. I'll leave it at that. And Roar, because I mean Roar lives at PieTrade and it lives at ETFsyourself.com. Those are the two places it lives. I mentioned the Seeking Alpha very, very briefly, but a lot of guidelines there, and so not a whole lot of talk about this over there. So that's kind of what's coming next. Um, Look, one more note on the NVIDIA. Okay, it's not an exact science, but I think there's something to be said for, okay, if this thing is confused, well, then that's probably telling you, as I like to say, no false moves, Rob. Okay, no false moves. And as a result, like a lot of the market itself, you expect it to go where this one's going in such a big portion. Okay, it is um, flattish. This is what a lot of the market looks like. Um, I'm sure if I put SPY in here directly, okay, I mean, this is unique. Okay, for this to be in mostly yellow zone, average risk, okay, fine. It was telling you, hey, nothing to look at here. Okay, if you have the opportunity to take a winter vacation away from the markets, you're not going to miss that much. It's kind of what it said. But then this happened. Uh-oh. And it doesn't mean anything yet, just like it didn't mean anything here. But um, this thing, because again, it's all just based on my decades of charting, putting it into some type of repeatable, reliable formula that has, let's call it a high batting average or a high free throw percentage. Okay. Um, you know, what I'm looking for right now, this looks a little like this, and it probably looks a little like many other periods we had in the past. It's hard to tell when you look at it like this, but again, it's Roar, if anything else, remember, it's telling you how much risk there is, how much risk of major loss. And if it does that, I think it's done a lot. Uh, okay, I've said a lot. I have a few questions, and now what I'm going to say is I'm going to read the questions, but I encourage you here or info@sungarinvestment.com uh, to ask us all the questions you like. So let's see. Let's see. Okay. First question. Thank you for the question, Jody. I looked at some of the ETFs you recommended Sunday. Okay, let me just stop there. I want to be careful about the terms we use because I do not recommend anything. I explain and have opinions on stocks, ETFs, etc. Um, you actually hit on the exact right point that I wanted to make more strongly than I probably have. Um, this is not an environment, a service, a mentality where you say, okay, he gives me good picks. I mean, that's part of it. But um, if this is, something where you're less likely to take it upon yourself to execute. Um, this is a portfolio, learning how to be a portfolio manager, DIY portfolio manager, service. At least at the higher levels. I mean, the weekly, put that out. Anybody and people can learn from it, and I think I talk a lot more straight talk than a lot of folks do around here. Okay, but recommendations. I know everybody who hasn't managed money as long or as much of it as I have over the years probably is like thrilled that people are like, hey, they're going to take my picks. Okay, I'm making a recommendation. I mean, I don't know anybody well enough, like I knew the clients back in the day. That's the difference between fiduciary and non-fiduciary. So your recommendation is not to do anything. I will give you an opinion. This is why in my Seeking Alpha articles, for those of you who know me from there, I mean, I can't stand the buy, sell, hold thing because what does that mean? Simple example, and I think I've shared this recently in the writing. Okay, anybody out there says, let's hear, okay, let me see here, BTAL. Okay, it was one of the ones you brought up in here. Okay, and then I'll answer the question. Okay, so um, somebody would say, and let me just read the rest of the question. Okay, I'm also interested in PDAC about commodities. Don't understand how to invest in otherwise. Still against JEPI. Okay, good. There's a few good questions in here. All right. So, yeah, looking at the uh, 10 ETF portfolio, okay, not a recommended list, and it's this is not about timing. This is not about is it a good buy or not. This is closer to, if you want to look it up, what's called a permanent portfolio. I haven't used that term enough, but I probably have to because I see, this is on me to make it clear because, a few people kind of gone down the road that this question is, okay? My approach to investing is not here, let me give you the stuff I think is going to go up. To me, that's freaking guessing, okay? And judging by the fact that the average S&P 500 stock has gone just about nowhere for 4 years, what does that say about all those buy ratings? That they stink. They stink on ice, to old Mel Brooks line, okay? They stink on ice, all right? Because it's just people throwing stuff out there to get people to follow their work or pay them to do something, whatever, okay? Here's the point. We can take any stock, any ETF we want. And my question is not, do I want to own it or not? It's how much of it do I want to own? And that's not a yes or a no. It's an answer from 0 to, in the case of certain ETFs, maybe 20, 30% in a two ETF portfolio. It's 0 to 100%, SPY and bill, like we discussed before. So that's the difference in mentality. That is portfolio management, what I just described. It is putting the pieces of the puzzle together, not collecting investments so that you can have a closet full of them that all move up and down together. And you're thinking, oh, they were all working out so well. And then they were all working out not so well at the same time. That is called correlation or R squared. And one of the first things I try to help people go from the dark side, the other side, to the bright side, which is understand investing in portfolio management, because you can do it yourself. And it's very empowering, by the way, uh, when you actually start to see that these are puzzle pieces moving around. Okay. Uh, Once you get to that point, you start to realize most of these things are going up and down together. This group of 10 tends to spray in different directions. Did I put the chart in here? Did I put the chart in here? I don't know if I did. No, I put this chart in here. Okay. Uh, and look, because you took the time, to spend with us today, if anybody has a list of, I don't know, let's call it 5 to 10 tickers, and I want to be like, hey, either I own a bunch of these, I follow a bunch of these, whatever, email them to us, info@sungardeninvestment.com, and I'll put them into a grid like this. What does this grid say? This says these things don't tend to move together very much. Okay. And it's a good thing because if you own 5 funds, I see this all the time. Um, I own 5 funds. Here they are. I'm like, no, you own one fund in 5 different flavors. Okay. Um, and there's nothing wrong with that implicitly. You're collecting investments, not diversifying, in the way you could, not managing risk for sure. Is going to be binary, all up, all down together. The problem is if you realize that after the market's down 10, 20, 30%, you're thinking, okay, it'll just come back. You don't realize you don't know what you own. Knowing what you own, why you own it, and stress testing your own process so that you every day, this is what I do every day. Do I really own that? Do I really own that? Okay. And I tried to simplify that for myself and now for subscribers and copy traders. Uh, I've tried to make it so that, there isn't a lot that doesn't track one of these. Almost every growth stock tracks this. A lot of stocks track this. Commodities, a lot of them tend to move together. Gold moves up, platinum moves up with it, silver moves up with it. Maybe they're a little bit out of sync, okay? But that's what we call beta, not alpha. Alpha is making money when the market gives you nothing, okay? I'm a historic alpha creator. If the market gives you nothing, I find a way to make something. Or if the market doesn't give you that much, I can try to make more. When the market does nothing but go straight up for a while, and the more aggressive you are, you buy Bitcoin and Ethereum when the Nasdaq's going up, okay, that's beta. That's not the wonders of crypto. It's animal spirits, risk on thinking, carrying it forward. So I want to make sure rest of the question. Let me see. Some of them have been going downhill for a while. Yes, that's exactly the point. And that's why the idea is, let's see, it's been going down for a while. I hope it's had a bad roar score. Yes, it has. Look at this. So basically, look, I set my own rules for people to borrow or copy. Okay. Why has this been going down? Because it goes down when the uh, when high volatility stocks outperform low volatility. Think Mag 7 doing better than the rest of the market, which has been going on for a long time. And especially during this period you've had, recently, yeah, this should be going down. So, well, why would I own it? Well, because if the entire market is an on-off switch 100%, you're just trying to be a trader, and eventually it's going to get you. Um, and so instead, the approach here in Roar 10, every one of these, I don't show it here, but every one of these has a minimum and a maximum and a neutral weighting. If this is how I tie it together. Remember, I said I wouldn't talk too much about the Roar score, but I'll do it here because it's, I think, vitally important to help you with the question. So for the last year, it's been mostly in the red zone. Okay. Only recently started to perk up and show a little bit of yellow. Well, that's because this is basically a shorting strategy. It says long short, but this is about two-thirds inversely related to the S&P 500. Okay, so if the S&P goes up 10, this will go down about 6 or 7, and then the opposite is also the case. Um, Quirky, fun, but effective. Effective is part of the mix, like I said. So BTOL, all right, over the last 12 months would be at its minimum weight, whatever that is. If it's 5%, 2%, 10%, it's not going to be maximum. It's not even going to be neutral because neutral would be average risk. So that's the idea. Okay. VIXI, I'm sure, same thing. Let me see here. You mentioned VIXI? Nope, nope. Okay. And but again, the defensives, okay, the real hard defensives that carry this thing when the market is falling, they are dormant. They're not zero because I don't want to wake up one day and figure out, oh, I wish I had hedged yesterday. Okay. This has been automated so that it takes a lot of that out. And again, uh, all I would say is look at my discussion of the past performance here, and understand that this portfolio is not an S&P 500 equivalent, although with a max drawdown of 5%, it's going to do pretty well in an S&P 500 decline. So that's BTOL. Let's see. PDAC. I feel like I've heard of it. PDAC. Oh, PBDC. Nope. Sorry. PDBC. Big difference between those two. You saw what I just put in there. Okay. So look, this is commodities, okay? And another good example, I'm just going back a year here. Roar score is currently at 40. I can tell I'm going to have to do another open session to teach this part of it. I'd be happy to. This thing's too good to keep under wraps. So for the longest time, commodities were kind of going nowhere, right? And gold started to perk up and it did okay. But then it really gave the green signal right around here. It's kind of like, hey, you know what? And look, a signal in one day is not as valid as if it stays for a while. When it's here, this is like, hey, I'm building momentum. I'm building for a rally. That's what green means. It doesn't mean no risk. It means lower than normal risk. This was average risk, and this was higher risk. It's an opinion to add to other opinions. It's not, it works in portfolios, okay? In securities, it works okay, but it's a portfolio building tool. So yeah, what happened at that point? Flew higher. Now, it's kind of stayed up here because again, this is my chart reading. I built it, somebody else programmed it, but I've been looking at charts with my eyes for 40 years, kind of the same way. So the problem with any, it doesn't matter if it's this or any other, any security that goes up this much, this quickly, okay, and we know why, it's silver and gold and now oil on top of it, okay. For what it's worth, I think I did say something. I got to find this from a couple of months ago, saying just I don't know what's going on. We didn't know what was going on in the Mideast at the time. I said I don't know, but the chart seems to be telling me a story. That's what I always think of it as. The story is telling me is commodities may still go up, even though gold and silver look like they're peaking, but oil is looking stronger. And so the fact that this thing is 50% energy and maybe 15% gold and 7% silver and the rest, the others, the ag metals, ag commodities, things like that. But it's 50% energy. So that part wasn't even participating here. And then all of a sudden you have that oil spike and it kept on. But it is the more something goes up, the more dangerous it becomes. Just a simple rule of Rob Isbit's, charting. Okay. So we have programmed Roar so that while a lot of technical systems would say, keep buying, keep buying, keep buying, and maybe it will work out, but it is much more vulnerable to, frankly, just take some news out of the Mideast and, oil can give it back quickly. So in this system, it gets trapped. It can only go up so much when it's already gone up so much. That's risk management, not speculating like it's who's going to win the World Baseball Championship tournament tonight or who's going to win all the first round games this weekend at March Madness. Okay. Investing has become a sport to too many people, and I'm trying to bring it back to what it is, which is a financial survival tool, making money on the money we have, and a tool to get what we want out of life. That is what investing is to me. Okay, let's see. Jeppy was the other one. And one of the first things that I asked them when they started programming this, let's see. In this mode, they're actually correcting this in the system, but in this mode, Jeppy is, I'm not sure if it's including all the dividends. All I will say about this, um, I am not a fan of covered call ETFs the way virtually all of them work, and here's why. It's a false promise. It just is. Uh, and it's nothing against any of the providers. It's just the structure. I've operated in that structure before. I mean, I used to run, option hedged mutual funds. The problem with these is that people run to them for the yield, and they get the yield, but the total return of those funds is going to be the same or less of the stock or underlying stocks, whether it's a single stock covered call or something like this. I flagged Jeppy a few years ago as being a lot of false hope, and it's been fairly mediocre since then. They can help by changing the structure a little bit, but for the most part, they're just getting people in with the high sticker price, the yield, um, and for the life of me, I do not know why a whole generation of retirees and future retirees have not realized that if the market stays down for more than a couple of months at a time, which has been the norm, that these things are going to be uh, the source of a lot of angst and probably incredible business era for securities attorneys. I'll leave it at that. Okay. Because I just don't think that people will say, "Yeah, I'm okay with it. I know it works that way." But I mean, I've done a whole study on it. I put out the study a few months ago. They're no better than owning the stock, and maybe worse. Okay. Let's see. Two ETFs, SPY and SH would perform. Try it at home. Yeah, a little bit arbitragey there. I don't know how that would. SPY and VIXI, I have tried, and I'm experimenting with that. Um, it's very tricky, and I think that that's where a two ETF portfolio, like again, part of what I do in the Roar 10 and some of the premium stuff is, in the portfolios you build. Once you start to build one of your own, um, and I'll just show you this to you very, very quickly using, I don't know, just about anything. Okay. Let's put in SPY. And let's put in TLT. And I'm just using this so it will come up. Okay. And let's put it in small caps. All right. So here, there. Okay. This is a beautiful feature. Not easy to understand, which again is why I'm happy to spend more time in the private sessions. I mean, okay. We have the instructions, but again, maybe not intuitive. So I'll just say it here. Okay. So when you see this is saying to you, you can do what I do in the 10 ETF portfolio, the Roar 10, or some of the more sophisticated portfolios, but you can do it with as few as just a couple here. You can say, okay, some people might say, I never want less than 50% in SPY, but I also never want more than 90. And a normal would be 70. But then when it comes to TLT, I never want more than 20%, just throwing in numbers. I'm okay having zero, and my neutral might be 10. And then the small caps, okay, uh, I'm willing to have, oh, I don't know, maybe small caps will get really crazy. This isn't me talking because I don't love small caps, but okay, I'll go up to 40%, and I always want to have a little bit in there. Okay. And in the middle, I'll just call it, I don't know, five. Let's see. Let's make it 20 because these will all add up. Okay. You do that. I'm not going to worry about what the benchmark is. Boom. There it is. See how quickly I just created a portfolio, really just for a demonstration, frankly. Okay. Using this system, Roar scores applied, the rules we just applied. And look at this. This is not bad versus the average S&P stock, 19% a year. Maximum drawdown, 8.5. It is only one, I guess, 1 year back. Okay, I don't know what it would be if we go back maybe 5 years. Okay, it might be a little different, but yeah, it smooths that a little bit. Oh well, beginner's luck, right? But still, the fact that you can do that on the fly, I did that with no thinking. Imagine if I teach you how to think through this. Now you're your own portfolio manager. That's why we created this tool. That's why I would like people to tell everybody they know, because what I just showed you is free for an email until we start charging for it. And even when we do, there's a possibility that the early adopters will get an incredible price break. So, best tool that I've seen, and I love using it. And that's what a lot of these groups are going to be about. You guys telling me what you want to learn, I'll help you learn. Okay, so let's see. A few more questions here, and then we'll close up. Okay. And thank you, Jody. Hope you learned something. And thank you very much for attending. Okay, Dusty, let's see. Yeah, new subscriber. Thank you, thank you. Okay, are the portfolios like the 10 ETF portfolio designed in consideration of taxable accounts? I see some hints of yes. Specifically, is the total return tracking in your model take into account the turnover? So, I was never a tax advisor, even when I was an investment advisor. But I was always tax conscious as an investor if the clients asked me to. Uh, I tend to believe taxes are only important until the market falls, and then, it all takes care of itself. But that said, as always, Dusty, I want to try to help. So let me speak more in terms of capabilities, because that's really what this is about. So if you look at the 10 ETF portfolio, ROR 10, um, this, because every Wednesday morning, like we will tomorrow, take the latest scores, look it over, make sure there's nothing really awkward about it, and they go and make the trades. I give it a quick look, and that's it. I'll do that with all these premium portfolios. we when when that happens, it's not looking at taxes because every Wednesday is potentially a live day. If you get something that's set up for, long time, I mean, partial, you're not selling all the position. So it's not 100% tax inefficient, but it's definitely not tax efficient. What I would say, however, is that, and again, this is the type of coaching I think in the premium, the $600, a year versus the 150. That's something where I'm not going to tell somebody what to do, but I will take an example that maybe somebody can give me, or take an assignment and say, hey, I'll come back next week, and I'll use that as an example. So already I'm thinking, okay, there's a way you can make it tax efficient. Uh, and the way you make it tax efficient, well, there's multiple ways. One is you have tighter ranges. See, now this is great. Now we're talking like portfolio managers, right? And I'm just the head of the investment committee. Maximum, minimum, and neutral. Well, if these are a little bit tighter, you can do that. You can also decide, you know what? And I've thought about doing this. Okay. So I'm really glad you brought this up. What if you say, okay, these two, let's pick a number. They're always going to be 25%. Always, always, always. You just got tax efficient. Why? Because half your portfolio isn't moving. Well, wait a minute. But what if the market falls? That's what the other positions are for, whether there's one, two, three, or eight others. It just means that you have to factor in that 50% is always going to be in equities versus maybe, sometimes it's more, sometimes it's less. I mean, there's a range here, but you can do that for any of the ones you want. And that takes it out of play, if you will. You've neutralized it, literally. And it's only going to be sold when you decide to sell it. There's nothing wrong in portfolio construction, no matter what your objective is, having some positions not go anywhere. Okay. Um, and then you can work around it with the rest. The other thing I would even say, and I'm going back now to my advisory days, and I'm thinking, geez, I think I actually did this in some cases, like end of the year kind of stuff. Um, you can pick whatever percentage of this you want. I mean, you can say, okay, you know what? I am going to be buy and hold for X percent, 70% of the portfolio. And the other 30% is going to be my little rotating device. Okay. Frankly, if the markets got to the point where they're even more in sync than they are now, I'd have a choice. I probably would take some of these, and at least for a time, I might make them neutral positions and just do it that way, and then work around it. And that's the thing. Markets are not so diverse at this point where, well, but if I do that, I'll lose out on so much. No, because most stocks don't outperform the Qs because all the money goes into the Qs and it pushes it up along with the SPY. Okay. DIA maybe gives you a little more flexibility, maybe IWC. But you'll see over time, this stuff is all correlating. It's all one big risk on, risk off party. And as a result, I think that there is some room to even simplify parts of this, especially for the tax considerations, which of course people decide on their own. But at the model level, like that's a great example of what I hope to do now that I have all the elements. I always had the the experience, the sheepskin, okay, the time in the trenches, if you will. I put a lot of this out there. Now I have this. Now I have a portfolio builder, and that's pretty cool. All right. Any other questions before we finish up? All right. We would love to know what you think. We would love to know whether you're listening live or if you're hearing this on a recording. We'd love to know who is interested in, well, any level beyond what you're in, but 150 a month. I explained, kind of the weekly written only. 600, you're in the room like this and getting the recording every week. And we're even thinking, can we go beyond that? Can we do something that's a little more, let's say, hands-on coaching without being direct investment advice? I think we can do it, but before we even try, we want to know if there's demand. Because look, the bottom line of all this, and thank you for staying with us this long. I mean, it's worth doing this quarterly, I think, for sure. Um, if Dana and I are, yeah, everybody like to make more money, okay? But we're in this because I still have some gas left in the tank, as they say. There's a lot of things that we can do to make money, especially in the world that I work in. Uh, but this is meaningful to us, and so we'll try and think about creating anything that we think will help more than a few people, but it doesn't have to be the masses. So, to the extent you want to let us know how you think we can help you, and if you think you represent others the same way, and how to price it and the whole thing, we'll try to follow your lead. Um, because we're in this to be useful and be paid fairly. And with that, I wish you all a good Tuesday night, and truly, truly would appreciate any feedback that you folks have, because we design ETF yourself around you. Take care, folks.
All right. Thanks, Rob.